Welcome back to Ask the Compound, the show where you ask and we answer. I'm Ben Carlson. Is it possible to use leverage in your portfolio in a responsible manner? Can leverage actually give you an even more diversified portfolio? How does return stacking work? We're going to cover these questions and more on today's show. Stick around. All right, our email here is askthecompoundshow@gmail.com. We usually do these shows live. Today we're pre-recording because I'm a modern-day Clark Griswold, taking my family to Disney for the week.
What's the best Thanksgiving movie? I know you've got one.
Well, it's Planes, Trains, and Automobiles, obviously.
Okay. That's
I got something on that for today. On today's show, we're answering questions straight from our compound inbox, as always, on how to use leverage in your portfolio responsibly. Why doesn't Ben, that's me, pick individual stocks anymore? How the 4-year rule works. A young guy asks if it makes sense to use buy now, pay later from a time value of money perspective, and then does it make sense to just pour your money into a target date fund and a handful of Vanguard ETFs and call it a day? Today's show is sponsored by Public. Public is the investing platform for those who take it seriously. You can build a multi-asset portfolio of stocks, bonds, options, crypto, and more. You can also access industry-leading yields like the 3.8% APY you can earn on your cash with no fees or minimums. But what sets Public apart? AI isn't just a feature, it's woven into the entire experience. Josh actually just talked to the two founders of Public about their new AI trading platform on the compound. Check that out. From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. Plus, earn an uncapped 1% match when you transfer your portfolio, including IRA transfers, rollovers, and even contributions. Fund that accountant at Public in 5 minutes or less by visiting public.com/ATC. That's public.com/ATC. Paid for by Public Investing. Full disclosures in the podcast description.
Those new agentic features are going to be really cool. I think they launch in January, but yeah,
it's pretty neat.
Pretty cool.
Yeah, starting to see the AI stuff actually come to light here.
Also,
right,
you're going to go to Disney, have a great time, and you're going to buy Disney stock. So you're going to be back into single stocks. I can feel it.
I sold it. I owned it forever, and I decided to own Disney. I'm like, hey, I'm going to buy some shares and tell my kids, like, this is how we learned about the stock market. And it fell like 50%. So that they learned about the stock market the hard way. All right, let's do a question.
About right. All right, up first today, we got a question from Bruce. Hey gang, are you familiar with return stacking? I'm looking for increased returns without those silly 2 times bull ETFs. Notice they didn't say 3 times. Return stacking is the practice of using modest leverage to layer multiple sources of return on top of a traditional portfolio, typically composed of stocks and bonds. The goal is to increase expected returns while maintaining or even reducing overall portfolio risk. For example, 90% equities and 60% treasury futures for a 150% notional exposure. These practices didn't work for the last 5 years since bonds have been in a bear market, dragging down nearly all of return stacking ETFs available. But now it seems like bonds might finally have found a floor since the yield to maturity on TLT is below the Fed funds rate. What do you think?
All right, we have the perfect person to help answer this, Mr. Corey Hoffstein from Newfound Research.
Hey, Corey.
Thanks for having me, guys.
Corey, did you actually coin the term return stacking, or has it been around for a long time?
I wish I could take credit for it. It was my colleague, Rodrigo Gordillo, who did come up with it, though. So this is actually a new term for something that has been around forever in the institutional space, as I'm sure you're aware, Ben, called portable alpha, going back to the 1980s with PIMCO.
Right. So yeah, the return stacking does seem pretty new. I've heard it from you for the first time. So what do you think about our guy's Bruce's question? Did he explain it well enough for you? Is there anything you want to poke holes in?
No, I think the original explanation is the right way to explain it, that you are inherently using a modest amount of leverage to try to introduce diversifiers into your portfolio. A lot of what we're ultimately trying to solve is how do we get investors to introduce things like gold or managed futures or long short equity or alternative investment strategies that have historically diversified but are hard to hold on to when things like stocks and bonds are just nonstop going up. And so return stacking is one way to do that.
The general idea is like, listen, I want to carve out a sleeve for some of these other different asset classes, but I'm having a hard time figuring out what to carve out and what to take out, and maybe I don't want to do that. And this is a different way of doing it. So, so how does it work? What does the leverage look like?
So that's a big open-ended question, and I'm going to try to keep it as concise as possible. It really depends on the product, but in the example that
that 90-60
was given, the 90-60. And if it's okay, I'm going to just use a 100-100 because the math is a little bit easier. For every dollar you invest, you're going to get $1, say, of equities plus $1 of bonds. And the way a strategy like that is going to work is it's going to get exposure to something like the bonds through futures markets. And futures markets are derivatives, and they're going to give you the total return of the bonds minus the cost of leverage. The reason this strategy works is because to get, say, $100 of exposure to bonds, you might only have to put up $5 of collateral, and then you get that full $100. But there is an embedded cost of leverage there, and as the writer of the email correctly points out, it's about the Fed funds rate or short-term T-bills.
Okay, and the idea is, yes, you're using leverage here, but since you're doing it to buy bonds, it's not like you're like going crazy here, right? You're not borrowing to buy Bitcoin or something. And then the idea is you have this excess money. If you want to keep it at 100% notional, then you can invest in something else essentially, right?
There's two ways to think about this, right? There's I'm a 100% equity investor, and do I just want to add some other diversifying asset to my portfolio, right? This is actually goes back to a paper that Cliff Asness from AQR wrote back in the early 1990s. Why not 100% equities? And that paper actually showed that if you took a 60-40 portfolio and levered it 1.5 times, you got the same risk as equities, but a much better return because it was more diversified. Jeremy Schwartz from Wisdom Tree, about 20 plus years later, replicated that and found out a sample that held true. That, again, this idea is more diversification plus a little bit of leverage is better than concentration. So that's one use case. The second use case, though, and I think this is really important, is that you can use these tools to actually free up space in your portfolio and not have to sacrifice exposure to stocks and bonds, but then introduce these diversifiers as a layer on top without having to manage any of the leverage yourself. So they're really distinct cases, and I think it got maybe a little bit muddied in the question, but I think it's worth pointing out.
So for your funds, how do you determine what that other piece is going to be? Is that based on investor preference? Like you say, using alts, that could be a lot of different things. Like how do you determine what's the reasonable thing to put the rest of your money in that you have to play with now?
Yeah, so we offer a suite of funds, return stacked ETFs. We have 7 different funds. Some of them are what we would call prepackaged alternatives. So just as an example, we have a fund, RSST. You invest $1, you get $1 of equities plus $1 of managed futures. But we have another fund that is a stocks plus bond fund. Every $1 you invest, you get $1 of global equities plus $1 of treasuries, RSSB. And that fund isn't really meant to be used to say, let me add bonds on top of my portfolio. That fund is really meant to be used as a choose your own adventure, to say there are alts that I like as an allocator, and all I want to do is figure out what I want to stack on top. Now, what is critical for us as we consult with all of our clients is that we're always advocating for them to choose liquid diversifiers that they really have strong conviction in, not only will have positive returns above cash over time, but will also be uncorrelated to stocks and bonds.
Right. So yeah, you're not putting it in something illiquid that's going to completely be a mismatch, and that makes sense. What do you do when someone is just deathly afraid of leverage? And hey, I heard a Charlie Munger quote about how leverage can crush you. Like, how do you explain it to people that you're doing so in a responsible manner?
Yeah. So people are rightfully afraid of leverage, right? If we look at every major financial catastrophe, leverage is there at the scene of the crime. But it's rarely alone. It's there with typically excess and illiquidity. And so one of the things we often talk about is with leverage, we want to avoid lice. Leverage that is illiquid, that is concentrated, and that is excessive. So for example, we don't want to use leverage to take someone who's in a 60-40 portfolio and just add more stocks, right? Or just add more bonds. We want to use leverage to introduce diversifiers that can fill some of the holes in their portfolio. I think, for example, 2022 made it apparent that a stock bond portfolio is pretty sensitive to inflation risk. What can we add that might help serve as a ballast in that sort of environment? And then make sure we're using a modest amount of something that is highly liquid so we can easily rebalance our portfolio. And that's the key to us.
Okay, so one more thing from me here on this. Bruce in the question asked about the changing nature of the bond market and how that can impact this. What does that do to this strategy? If the bond market changes, does that make this strategy more or less beneficial to investors?
Yeah, so at the risk of oversimplifying, right, we're just saying the cost of leverage is basically T-bills. And so when you talk about a standalone product that is giving you stocks plus bonds layered on top, and you have a flat or inverted yield curve, you're actually paying more for the leverage than you're earning in the thing that you're stacking. And so a lot of people look at that and say, well, it's not a good time to stack. What I would respond is, well, what you're implicitly saying is that the shape of the yield curve is a market timing signal for duration. Do you really believe that? Do you believe that you can time bonds based only on the yield curve? Some people might say yes, some people might say no. My empirical evidence suggests it's not a very good market timing signal. So if you are just thinking about stacking bonds strategically, I don't worry too much about the timing. That's the first use case. The second use case, though, where you're using a tool like this to free up capital, it doesn't really matter, right? If we say have a 60-40 and we sell 10% of our stocks and 10% of our bonds to buy 10% of, say, our RSSB product that's going to give you the stocks and bonds back, that bond overlay is going to have a leverage cost of T-bills. But if we take the freed up 10% that we now have and invest it in T-bills, well, those costs net out. And so then if we take that freed up capital and we can either leave it in cash to deploy opportunistically or tactically allocate it, or we could invest it in a diversifier, then all we're really saying is it's not that we need the bonds to beat cash. We were just using the leverage to get our bond exposure back. We need that alternative to beat cash, i.e. our cost of leverage.
And which hopefully a lot of those alt strategies are like a cash plus, right?
Exactly.
They kind of, yeah, which makes sense. So I guess the biggest selling point of these return stacking funds that you use is just it offers you more flexibility.
I would say it offers you more flexibility and it allows you to incorporate these alternatives without having to sacrifice the core stocks and bonds that you know and love.
Right. Okay.
It also
so,
sounds like it
go ahead.
simplifies, right? You don't have to hold as many things to get the same thing in your portfolio, kind of. Is that
Yeah, in some cases, like with prepackaged return stacked, beta plus alternatives. Yep, you get them. You get 2 in 1.
Okay. So talk Duncan off the ledge because he's like a 3 times NASDAQ 100 guy.
Listen, here's what I'll say. If you've got 3 times NASDAQ 100 and you put 1/3 of your portfolio in it, you now have 100% NASDAQ 100 with 2/3 of your money sitting in cash that you can do with whatever. Now you got to keep rebalancing that, but hey, that's not a horrible use of capital.
Yes, but that's the idea, right? Is that a lot of people could put more than that in, and okay, all right.
Yeah, that's cool. Got my wheels turning. I didn't know anything about this. Completely new to me.
Well, tell people where they can go to learn more, Corey, since you're here.
Yeah, returnstack.com or returnstackedetfs.com.
All right. Appreciate it, Corey.
Thank you for the time, dudes.
Thanks so much.
Thanks.
See ya. Okay, that's
pretty
pretty
interesting,
cool.
right?
Yeah, I read that question. I was like, return stacking. I have no idea what that.
I'm constantly commenting that like the amount of options that individual investors have today in funds is just so much more than they could have ever imagined. In the past, this stuff was really only for institutions, and institutions were paying up to their eyeballs for this stuff. Now you can get it in like an ETF structure for a relatively low cost. You have to understand what you're doing, obviously. But it's pretty amazing that individual investors now have these kind of things in like a tax-aware strategy.
I've been doing a deep dive into like all the different active ETFs out there, and because they're like you're saying, there's so much cool stuff. What I worry about is, are there going to be too many ETFs where they can't get enough, assets to actually make them viable long term? That's
it could be, and part of that is investors are just tempted to jump from this to this to this.
Right. But
this is the kind of strategy you have to. This is more of a portfolio management strategy that you have to stick with, right? You can't just jump in and out because you feel like it.
Right. Yeah.
All right, let's do another one.
Okay. Up next, we got a question from Dan. Ben has said on multiple occasions that he only buys ETFs and doesn't buy individual stocks. I largely agree with that long-term strategy. How does Ben resist the urge to buy stocks that seem like a great value or are temporarily mispriced? This is a good question because this is your life. Like you're following the market all the time. Like you gotta feel some temptation to buy stocks here and there. Right.
And I think this guy too. We try to shorten these questions sometimes. He talked about how Google. He said he made good money buying it in 2023. And it is funny to think that there was this period of time for a few months where people thought Google was toast. Right. It's like, why do we need Google anymore when ChatGPT exists? Like that was a worry. Google fell almost 20% in early 2023. Did I put the chart in here for this, Dan? Give me a chart on. Since then, Google is up over 230%. And now appears they're winning the AI race, which is, I'm sure that narrative will change at some point too.
Well, yeah,
Chart
it's
off.
now people use it interchangeably. It's like, oh, I
Yeah.
ran out of my free ChatGPT. I'll go use Gemini.
But yeah, yeah, exactly. People are probably going to have multiple models. I think at first everyone thought there's going to be one winner. Now there's probably going to be multiple ones, right? Like, oh, this one can't do this for well, but it can do this. Or I'm going to have all 4 of them working at once to see what happens. So do I miss out on stuff like that by not being a stock picker? Yeah, I do. But you know what else I miss out on? The ginormous losses. All right, so chart on here. This is, I just pulled up a handful of blue chip names. I ran it through a screener on YChart to see like some large drawdowns. So this is showing, this is from all-time highs. Nike is 65% off all-time highs. Boeing is down 60%. Pfizer is 60% off all-time highs. Intel's 50%. Disney, like I mentioned before, is down 50%. And Oracle's down almost 36%. These are big, blue chip names. These aren't like small, random meme speculative stocks.
Right. The crazy part about this list to me is how many people 10 or 15 years ago do you think would have guessed that these would lose this much?
Oh, never, right.
Yeah,
If you would have said, give me a bucket of these blue chip stocks, they all kind of pay a dividend too, sign me up. You can do chart off, Dan. The S&P is down less than 5% as of this recording. Okay? Again, these stocks are down 60%. This is like a 2008 level crisis, right? For these stocks from all-time highs. The S&P is down less than 5%. So, listen, that's the trade-off. By mostly indexing and staying diversified, I give up on the home runs, but I avoid striking out. Plus, the way that I look at it is there's far less brain damage in my investment process. So I never had a huge piece of my portfolio for stock picking. It was never my thing. I was never that guy. I clung to index funds pretty quickly. That made sense to me right off the bat. But I did have a Robinhood account that made up like 10% of my portfolio. That was mainly used for crypto and stock picking. The problem is I spent 90% of my time worrying about 10% of my portfolio. Checking the prices, checking the quarterly earnings calls. It just was not worth it to me personally. Some people love that game. I don't. I still dabble here and there. After Liberation Day, I bought a little bit in NVIDIA because it's down 35 or 40%. Okay. I bought Nike recently trying to catch a falling knife. I think those are the only 2 stocks I own at the moment. But these are tiny, tiny positions. Even my brokerage account now, it's basically all index funds. I'm so boring. And since it's Thanksgiving week, I got to kind of semi-quote the immortal John Candy in Planes, Trains, and Automobiles when he says, yeah, I'm making my own quote on this. Sure, it's boring, but I like me. My portfolio likes me. Right? I like being boring. It suits my investment process. It's okay. I miss out on the huge gainers, but guess what? I own I own a bunch of total stock market index funds. I own NASDAQ 100 index funds. The winners end up there eventually, even if I don't see the individual ones. I'm okay with that. I think as an investor, you just have to be okay with all the trade-offs. If you're a stock picker, the trade-offs are like a way wider range of returns, right? You can be down 20% on a day. You can be down 60% in a year when the market is going up. You could be up 300% in a year when the market is going down. Those are the trade-offs. That's my trade-offs that I'm willing to accept.
As someone who loves trying to pick stocks and having very mixed success with it, I feel like I end up in the same place over the long run. It's just I have a lot more fun in between. You know what I mean? Like I get some big winners, I get some big losers. Maybe they kind
Are
of
you
net
actually checking your portfolio, benchmarking it correctly? Because I think most individual stock pickers are not actually benchmarking correctly to like what they could have gotten in an index fund.
I look at different time frames and I pick the one that's green.
Exactly.
If I'm talking about my portfolio. That's what I do. Yeah.
All right. So
and on this note, I was asking you offline earlier today, like is now a time to panic? And the reason I'm being a little facetious, but either you or Josh or someone has talked about before, if you are going to panic, if you are feeling like you're going to get shaken out of the market, you should do it earlier rather than later. Is now, I mean, we've had a pretty rough week in the market. NVIDIA, blew out earnings and proceeded to sell off. Like these don't seem like, to someone like me that is not a market expert by any means, these things seem like a bad sign.
Yes,
what would you say to that?
Thursday felt crazy. It was like the market was up, NVIDIA's up 5%, and then it rolled over, and everyone's going, oh my gosh, this seems bad. Back to my boring stuff, like there's never a good time to panic, okay? Never. I don't think it ever makes sense to panic as an investor. Unless you think you're going to get blown out of these stocks or these triple leverage whatevers when the stock market falls, then yeah, sure, it makes sense to panic early and sell. But if you have the ability to stick with your plan, then there's never a time to panic. How's that?
All right.
Listen, I don't care about. I don't mind people who pick stocks and stuff. I understand it. I get it. It's interesting. I still follow a lot of this stuff. For me, being on autopilot and just giving my brain a break from that, partially because I follow the market so closely,
Right. Right.
right? It's like I don't want that extra piece of it to like have this pain. It was funny, like I'd have one stock that on earnings day was up 20%, and the same day another stock reported earnings, it was down 20%. And guess which one carries more mind share? The down 20%, right?
Yeah.
You don't you don't like celebrate the up 20%. The down to what?
It's
So
true. It's true. But I'll keep doing it, and I'll keep
you're
things
right. It is. It
exciting.
is. It is fun. It is kind of entertaining for people, and it's a way to like stay in touch with these companies and stay like. I think you can learn a lot about the economy from some of these companies by following them. So I think it is. It is interesting, but just
Well,
not for me anymore.
I've said this before. I used to be super into fantasy baseball. Like I'd be in multiple leagues and actually like managing the teams to a ridiculous amount of detail, and I basically quit doing that and decided that the stock market was more fun for doing research and trying to pick things, and you actually can make money instead of it just being for
See
fantasy
that's why
baseball.
you should know that I would never be a stock picker because I've never played fantasy anything in my life.
But you do sound like a real big on base percentage guy. You know. For real, that's what you care about. You're talking about your strategy is very on base percentage, money ball type thing instead of like slugging percentage or
That's
swinging for the
fair.
fences.
Yes.
Yeah.
Yes. I'll agree with that.
All right.
All right. Let's do another one.
Up next, we got one from Craig. Ben has mentioned the 4-year rule a couple of times on the podcast and offered to share the full strategy. Can you share it with me?
Okay, let's do a story time here. I think I've kind of mentioned this before in bits and pieces, but when I first started the blog, I get these random people that will reach out and ask questions and offer stuff they're doing, and I got this email from a guy named John Thies who said, "Hey, I try to help young people, and I teach a class to young people and try to help them save and invest. And I like the way that you present this stuff. Can I use some of your blog posts to send around to my email list of these young people?" And said, sure. And he teaches young people, and he also helped old people in retirement. And he was retired himself. And he shared his own story with me. And he shared this story that he retired in the spring of 2000 at the very tippy top peak of the dot-com bubble, which is, as far as I'm concerned, the worst entry point in stock market history so far. Even worse than the 1929, like in terms of valuations, it's worse than that. And he shared with me, and so I said, well, how did it go? Like, it's been 15 years or whatever. How, because this is, 10 years ago when I talked to him. And he said, let me share with you what we did. And he said he had this 4-year rule, and he based it on the idea that like major stock market downturns last like 8 to 24 months. That's kind of the range. Upturns last 4 to 8 years. These are his baselines he's using. Obviously, there's a range of outcomes, but these are the baselines. So he says 5 years before retiring, I accumulate a cash reserve that goes into money market or CDs or T-bills or some sort of cash, whatever, high yield savings account. And you accumulate 4 years of living expenses, net of any pension or Social Security income you'll receive, right? When you retire, if there is a stock market upturn, you just take your money out of the stock market, right? If there's a downturn, you take it out of the cash. And then he has these specific time frames, like, if you're taking it out of the cash, you wait for the stock market to turn back up and run for about 18 to 24 months, and then you replenish your cash, right? Because eventually you have to replenish it. And that was his idea, and he said that's what we did. We retired at the worst possible time. The stock market went into a 3-year bear market, and we took from our 4-year bucket and then waited for the stock market to turn up again and did the same thing in 2008. And it was very hard, but they survived, right? And so I shared his story a bunch of times, and every time I shared it, because he has this big, long piece that he wrote that has even more color and context and background to it. And I told people I'll send it to you. And so I think what I'm going to do, instead of sending people a Word doc now, after every one of these Ask the Compounds, I do like a companion blog post about something and do a deeper dive, right? Add some more charts or perspective. So I think I'm just going to publish.
That's wealthofcommonsense.com.
Yeah, so I'm just going to publish his whole 4-year rule on there for people if they want to go see it. Sadly, I think it was last year, his wife emailed me and said, "Hey, John always loved corresponding with you. Just wanted to let you know he got a really bad disease, incurable, happened fast, and he passed away." So he passed away, but he helped a lot of people. And Bill Sweet and I kind of looked him up, and the guy was a great guy. He had lived a great life. And anyway, a really cool correspondence. But his strategy, while not, I'm sure some people would quibble with it or find holes. Like I love the idea of thinking through your spending in retirement, like your bond or cash piece in terms of the number of years that you have to spend So like if you have a 60-40 portfolio and you spend 4% of your portfolio, in year one, you have 10 years worth of savings. And that framing it that way makes it so much easier for people to go, oh, okay. So as long as we're not set up for a 10-year bear market, I think I'm going to be okay for a while, even if I retire into the teeth of something nasty. It's funny. I love the way that he frames it in terms of spending instead of like trying to optimize some weird stock market return, whatever. So it's a really cool idea, and a lot of people I think have got a lot of use out of it over there. So I'll publish that for everyone. But it's
Cool.
I really like the idea.
Yeah, it makes a lot of sense to me.
Yeah. All right, let's do another one.
Okay. Up next, we got one from Victor. I'm a 20-year-old college student about to make a decently sized purchase of a couple $1,000s, upgrading my iPhone and Apple Watch. If stocks return 10 to 11% a year on average, would it be smart to use buy now, pay later as a way to increase my leverage through a big purchase? If I can spread the payment out over a year with no interest, I can invest that money now and reap the difference. Essentially, I'm looking to make the difference from a time value of money principle.
All right, last week in the comments, we kind of got roasted because we had too many not to brags, and so I picked a few questions by young people today.
Yeah, no, I like it. Yeah,
Yeah.
it's nice mixing it up.
what
Back
were you gonna
on,
ask?
Dan. I wasn't done.
Oh.
Okay, there we go. Essentially, I'm looking to make the difference using time value of money. Could you share some thoughts on this strategy's effectiveness and risk? What investments would be most ideal? Should I just use a cashback credit card and scrap the idea entirely?
Okay,
yeah,
I'm curious
what do
what
you
you think about this.
It makes a lot of sense to me. I've said to you before, I've used like credit card balance transfer things to kind of do the same thing where, trying to kind of, I don't know if that's arbitrage or not, but trying to like play the difference and being able to get some kind of return. Usually it doesn't end up being a big, savings or anything, but it's worked relatively well for me when I've done stuff like this.
I like the fact that he's trying to game the system, but I'm not sure that buy now, pay later is the way to do it. Okay, I think he's right. Like I would probably scrap this idea entirely because you like the buy now, pay later happens over the course of a few months, right? I think you pay it off. I've done it a few times just to try it. Like
Well,
I
it
did
depends
it.
on how big the purchase is, right? You can do like
Yeah.
a year if it's something like an iPhone, I think.
Yeah, but even a year, if he's talking about the stock market, you don't want to like do buy now, pay later. They're going to pay off in the year, put it in the stock market, and hope that that money's there in a year. Plus you have to pay taxes on it. Like that seems just like a step too far to me. I think you're probably better off using a rewards credit card because one, with a buy now, pay later, you're not developing the credit part that you get in a credit card, right? As far as I know. So the FICO score piece is better if you use a credit card. And in a credit card reward, Robinhood does the 3%, most of the Sapphire, whatever, American Express, Gold, Platinum, Silver, Bronze, whatever color they are, will give you something like 3% and also some other perks. I think you're probably better doing that and then investing the cash. And there are credit card rewards that will put money right into your Fidelity account, your Bank of America account, or your Robinhood account, right? And then use that money to invest. I think that's probably less, again, getting back to my stock pick thing, less brain damage. So I think I would be more apt to do that.
Well, because the buy now, pay later thing sounds like if that's your mentality and that's your philosophy, then why wouldn't you do that for everything? Literally
Right.
anything you could ever buy now, pay later for, you're technically keeping more money in your bank account today.
Yeah, so that time,
So time value of money,
Yeah, and I mean, I put literally every purchase I can on my credit card, and that for us, that's like 95% of all of our purchases, besides like my mortgage, which I write a check for. And the credit cards are floating me for a month essentially because I pay off the balance every month, right? So it's kind of the same idea. It just gives you some sort of buffer. But yeah, I think a credit card is probably the way to go. And if you're a young person, and you can take out, like you said, a 0% credit card because you have a big purchase. Like I remember when I was first out of college and the brakes on my car went out, and I literally graduated with zero savings. I had no money, and I'm like, this is going to bankrupt me. So I used a credit card and I paid it off over time. Like if you could do something like that to get you by when you need to, that makes sense to me. But I don't think
keep
like
in
taking
mind, those are never free. It's usually like 3 or 4% that you pay up front to get like a balance transfer.
Well, I'm saying if you take out a 0% credit card, then use the credit card,
right,
and you're not paying a balance for a year. But the buy now pay later of investing the money in stocks, that's like an asset liability mismatch. That time frame is way too short for me.
Okay.
I don't think you're really, that's too short.
And for our young people watching that are still, learning about the finance world, never carry balance on a credit card. That's always a losing proposition, right? I mean, that's
like
you got to pay off your
Warren
credit
Buffett
cards.
level anti-compounding against you. Yes,
Right.
that's Ben's number one rule of personal finance: do not carry a credit card balance.
Yeah, they're
It's-
great tools, but not if you carry a balance.
Yeah, it's about the worst thing you could do.
Yeah.
All right, one more.
Okay. Last but not least, we got one from Luke. I'm in my in my 20s and 30s. I spent a lot of time screwing off and not really thinking about the future. Since 2020, I've turned that around. I work a pretty low-paying but easy job at a golf course, and I invest consistently, mainly in Vanguard target date funds in my Roth IRA, plus a brokerage account with other index ETFs. I've got about $21,000 in the Roth and $35,000 in the brokerage. I'll pare down my ETF holdings in the brokerage at some point. My question is, should I just stick with this setup until I'm 65 to make up for lost time? The investment trackers I've used say I could end up with around $900,000, assuming a 7 to 9% return. Does that sound rational? I'm not asking for instructions on what to do, just your thoughts on the long-term plan.
So, Luke, you're not alone in screwing off in your 20s and 30s. That happens. A lot of people. For now, though, the fact that you turned it around and you're saving, it sounds like a perfectly reasonable strategy to me. But I think just as you are now in a different place than you were in your 20s and early 30s, like at some point your plans are probably going to change. You become a different person. Maybe you want a different job. Maybe a job that's not as easy. You want a harder job. Maybe you want to relocate. Maybe you find you need more than $900,000 to retire. Maybe it's less. Who knows? Depending on what you're doing and how much you're spending. I think the main thing is you just keep saving, and you probably try to find ways to increase your savings over time. The person you are in your late 30s is not the same person you were in your early 20s and 30s. It's not going to be the same person in your 40s or 50s. Your plans are going to change. So I think you just want to give yourself a buffer. But I don't know. Kudos and congrats for turning it around. Some people, we mentioned on last week's show, some people don't ever turn it around. We all know people like this. So the fact that you did, and yeah, you got it out of your system. Sounds like you went through like your ski bum phase a little bit. Yeah, you're doing good. Keep shoveling money into those Vanguard funds, and you'll be fine.
What do you think they do at a golf course? It sounds kind of like a fun place to work.
Caddy, maybe work at the bar, grounds crew. I don't know. What do you think?
Yeah. I was thinking maybe like working at the driving range or something.
I mean,
like
usually the beverage person is a female, almost always.
Well, I was a poolside server at a country club when I was in college. So,
Okay.
Yeah.
But yeah, working outside on the golf course is probably, hopefully they give you free rounds. Probably not a bad gig.
Maybe some
But I'm
free
sure-
golf. Yeah.
Yeah. So, but yeah, keep funneling money in, man. You're doing good.
Yeah. I mean, before this job, I was an adjunct professor with no benefits and no retirement from the schools that I was teaching at. So
Really? They
I
didn't
was
have
in my
any
early
retirement
30s.
benefits at the schools? I didn't know that.
Adjuncts don't get any benefits, period, at most schools. So it's
geez.
why all the schools are moving to using primarily adjuncts, or as many as they can. So,
That's nice. Thanks.
Yeah. Yeah.
All right. Well, so it's Thanksgiving week, so I just want to take a minute and give thanks to all of our wonderful viewers and listeners for sending in questions every single week. When we started this show, I worried that eventually people might stop writing in, or that we just kind of run out of questions. And
Right.
the longer we do this show, the more questions we receive, which is great. So we here at The Compound appreciate you all for that. Keep sending us your emails to askthecompoundshow@gmail.com. Happy Thanksgiving to all, and we'll see you next time.
And safe travels. A lot of people are probably traveling right now. So yeah. Stay
Me,
safe.
I'm going to be traveling.
Yeah. Have fun in Disney World. Also, just want to say thanks to John, Nicole, Dan, and Travis. My team. I'm thankful to have the best team in podcasting, in my opinion. I'm biased, but
They are the best. We appreciate it. Thanks, everyone.
All right. See you, everyone.